Have you ever wondered how to start investing? How to grow your money and secure your financial future? Well, you're in the right place. Imagine being able to multiply your money, not just by saving, but by actively participating in the world's financial markets. This is the power of investing. It's like planting a seed today and watching it grow into a fruit-bearing tree over time. The fruit, in this case, is the return you receive on the money you've invested. Investing is the act of committing money or capital to an endeavor with the expectation of obtaining an additional income or profit. Yes, it's about making your money work for you. Instead of keeping your savings idle, you put them to work, making more money. The importance of investing cannot be overemphasized. It serves as a means to achieve financial freedom and allows you to generate wealth over time. When done right, investing can help you reach your financial goals, whether it's buying a house, starting a business, funding your child's education, or planning for a comfortable retirement. The potential benefits of investing are enormous. For starters, it can provide an income stream, especially if you invest in dividend-paying stocks or interest-earning bonds. It also offers the possibility of capital growth. Think about those who invested in tech companies like Apple or Amazon in their early days. Their investments have grown exponentially over the years. Investing can also help protect your money from the effects of inflation. You see, when you keep your money in a savings account, its value diminishes over time due to inflation. But when you invest, your money has the potential to not only keep up with inflation, but also grow. Now here's the best part. Investing isn't just for the wealthy. Regardless of your financial background, you can start investing. All it takes is a little bit of money and a whole lot of patience and discipline. Remember, investing is not about getting rich quick. It's a long-term game. Investing isn't just for the wealthy. It's a powerful tool that can help anyone achieve financial freedom. Before diving into the world of investing, it's crucial to understand some basic terms and concepts. Let's start with stocks. When you purchase a stock, you're buying a small piece of ownership in a company. This ownership stake entitles you to a share of the company's profits, either through price appreciation of the stock or through dividends, which is our next term. Dividends are payments made by a corporation to its shareholders, usually in the form of cash or additional shares. Not all companies pay dividends, especially those that are still growing. Instead, these companies often reinvest their profits back into the business, which brings us to capital gains. This is the profit you make when you sell an investment for more than you paid for it. The difference between your selling price and your purchase price is your capital gain. But remember, if the selling price is less than the purchase price, that's a capital loss. Next up, we have bonds. A bond is essentially a loan you give to a company or government. In return, they agree to pay you interest over a certain period and to return the principal at the end of that period. Bonds are generally considered less risky than stocks, but they also usually offer lower returns. And finally, let's talk about risk tolerance. This is a measure of your willingness and ability to endure losses in exchange for potential gains. Some people are risk takers, willing to potentially lose money for the chance at higher returns. Others are risk averse, preferring safer investments even if they offer lower returns. Understanding these terms is like learning the alphabet before you start to read. They are the building blocks that will help you make sense of the more complex aspects of investing. With a basic understanding of these terms, you are now ready to take the next step in your investment journey. Investing without a goal is like sailing without a compass. You may move, but where are you heading? Imagine embarking on a journey without a clear destination. You'd likely find yourself lost, confused, and eventually frustrated. The same applies to investing. Without clear financial goals, your investment journey could become a ship adrift at sea, directionless and aimless. So, what exactly are financial goals? Simply put, they're the financial milestones you aim to achieve with your investments. These could range from saving for retirement, buying a house, funding your child's education, or even planning a dream vacation. Each goal has a different timeline and requires a different investment strategy. Consider this. If you're saving for retirement, you're probably looking at a long-term goal. In this case, you might want to consider investing in assets, that have historically shown steady growth over extended periods like stocks or mutual funds. On the other hand, if you're saving for a short-term goal, like buying a car in the next 2 years, you might want to consider safer, lower-risk investments, such as bonds or a high-yield savings account. Setting financial goals not only gives your investment journey a clear direction, but it also helps you determine how much risk you're willing to take. If you've got 20 years until retirement, you can afford to take on more risk for potentially higher returns. But if you're saving for a house down payment in 3 years, you'd likely want to play it safe. Remember, there's no one-size-fits-all approach to investing. Each individual's financial goals are unique, shaped by their personal circumstances, aspirations, and risk tolerance. So, take some time to reflect on what you want to achieve financially. Once you have a clear understanding of your goals, you'll be better equipped to make informed investment decisions. And remember, it's never too early or too late to start setting your financial goals. Remember, clear financial goals are the compass that guides your investment decisions. Now that you have your goals, how do you choose the right investment strategy? Well, let's delve into a few popular strategies, and you might see one that resonates with your financial aspirations. First up, we have diversification. Think of it as not putting all your eggs in one basket. By spreading investments across a variety of assets, you can potentially minimize risk. If one investment performs poorly, others may perform well, balancing your overall portfolio. Then there's long-term investing, or buy and hold. This strategy involves buying an investment, like stocks or bonds, and holding onto them for many years. The idea is that over time, the market will provide a good rate of return despite periods of volatility. Another strategy worth considering is dollar cost averaging. This is where you invest a fixed amount of money at regular intervals, regardless of the price of the investment. Over time, this might mean you buy more shares when prices are low and less when prices are high. This can take the emotion out of investing and smooth out the impact of market volatility. But here's the kicker. The best investment strategy for you depends on your individual financial goals and your tolerance for risk. If you're saving for a short-term goal, you might opt for a less risky investment, like a bond. If you're saving for retirement and have decades to weather market ups and downs, you might choose a riskier investment, like stocks. Also, consider your sleep factor. If the thought of losing money keeps you up at night, you might prefer a more conservative strategy. On the other hand, if you're comfortable with some level of risk in pursuit of higher returns, you might opt for a more aggressive strategy. In the end, your investment strategy is a personal decision. It's about finding the balance between risk and reward that feels right for you. The right investment strategy should align with your financial goals and comfort with risk. You know the basics. You've set your goals and you've chosen a strategy. But where exactly should you put your money? Well, there's no one-size-fits-all answer, but there are several types of investment vehicles that you can consider. Let's start with stocks. Stocks represent ownership in a company. When you buy a stock, you're buying a piece of that company. The upside of stocks is the potential for high returns. However, they also come with a higher level of risk, as their value can fluctuate dramatically. Next, we have bonds. Bonds are essentially loans that you give to a company or government in exchange for a predetermined interest rate. They're generally considered safer than stocks, but the potential returns are often lower. Then there are mutual funds. A mutual fund is a pool of funds from multiple investors that's managed by a professional. The fund manager uses this pool to buy a variety of stocks, bonds, or other assets. This offers a level of diversification that can be hard to achieve on your own. However, mutual funds often come with fees that can eat into your returns. Lastly, we have exchange-traded funds, or ETFs. These are similar to mutual funds, but are traded like stocks on an exchange. They offer the diversification benefits of mutual funds, often at a lower cost. But like stocks, their value can fluctuate throughout the day. Each of these investment vehicles has its pros and cons, and it's essential to consider your financial goals, risk tolerance, and investment timeline when choosing between them. Remember, investing isn't about getting rich quick. It's about steadily growing your wealth over time. Understanding the different investment vehicles can help you make informed decisions about where to put your money. So take the time to familiarize yourself with these options, and consider how they can help you reach your financial goals. In investing, as in life, higher rewards often come with higher risks. This principle is a fundamental part of the investment journey. Let's delve deeper into this concept. Imagine you're on a tightrope. On one side, you have the potential for profit, glittering and inviting. On the other side, the risk of loss looms, a dark abyss ready to swallow any misstep. As an investor, your task is to walk this tightrope, balancing your desire for profit against the inherent risks. Risk and reward in investing are like two sides of a coin, inseparable and constantly influencing each other. The potential for high returns often goes hand in hand with a higher risk of loss. Think of it like this: the higher you climb, the harder you could potentially fall. But also, the higher you climb, the more breathtaking the view. Consider a high-risk investment, such as investing in a startup. The rewards could be massive if the startup becomes the next big thing. But the risks are equally substantial. The startup could fail, and you could lose your investment. On the other hand, a low-risk investment, such as a government bond, offers more security, but generally lower returns. It's like choosing to stay on the ground. You won't fall, but you also won't get to see the view from the top. However, it's essential to remember that risk isn't inherently bad. It's just a part of the game. The key is managing your risk effectively. This means understanding your risk tolerance, diversifying your portfolio, and making informed decisions. Your risk tolerance is your ability to endure potential losses. If the thought of losing money keeps you up at night, you might want to stick to safer investments. But if you're comfortable with taking risks for the chance of higher returns, you might be more inclined to make riskier investments. In the end, striking the right balance is crucial. You want to reach for the stars, but you also need to keep your feet firmly on the ground. Remember, investing isn't about getting rich quick. It's about growing your wealth steadily over time. Remember, it's important to balance the potential for profit with your ability to tolerate risk. Investing isn't a one-time event. It's a journey. Now let's delve into one of the most pivotal aspects of this journey: regular investing. You see, investing isn't about putting in a chunk of money once and then sitting back with a bag of popcorn to watch it grow. It's more like planting a garden. You need to sow your seeds, yes, but you also need to water them regularly, and perhaps add a bit of fertilizer now and then. Investing works in a similar way. You don't just invest once and forget about it. You invest regularly. So, why is regular investing so important? Well, it's all about harnessing the power of compound interest. Imagine a snowball rolling down a hill. As it rolls, it picks up more snow, growing larger and larger. That's what compound interest does to your money. It's not just your initial investment that's growing. The interest you earn on that investment is also earning interest. And the more frequently you invest, the larger that snowball becomes. Now, let's talk about dividends. When you invest in stocks or mutual funds, you may receive dividends, which are a portion of the company's earnings distributed to investors. Instead of pocketing these dividends, consider reinvesting them. This way, you're increasing the amount of money that's working for you, leading to even more growth over time. It's like adding an extra layer of snow to that snowball. The beauty of regular investing is that it doesn't require massive amounts of money. Even small, consistent investments can lead to significant growth over time, thanks to the power of compound interest and reinvested dividends. So don't wait for that big windfall to start your investment journey. Remember, the key to successful investing is not timing the market, but time in the market. And the more time you have, the more potential there is for your investments to grow. Regular investing, even in small amounts, can make a big difference over time. So, start your journey today, one small step at a time, and watch your financial garden flourish. So, are you ready to start your investment journey? We've covered a lot of ground today. We began by understanding the basics of investing, a crucial first step that lays the foundation for everything else. Then, we delved into the importance of setting clear financial goals, which act as your guiding stars in the vast investment universe. We also explored how to choose the right investment strategy, a decision that should always align with your personal financial goals and risk tolerance. We discovered the variety of investment vehicles available, each with its own set of characteristics and potential returns. We discussed the delicate balance between risk and reward, a fundamental principle to understand and respect. And lastly, we emphasize the importance of regular investing, a habit that can significantly magnify your wealth over time. Remember, the journey of investing is not a sprint, but a marathon. Patience, perseverance, and knowledge are your best allies in this journey.